Today, I want to talk about a company that gained exposure for allowing millions to start their own business during one of the toughest years this decade. It's a company that's even facilitated the rise of multi-billion-dollar startup sellers. If you haven't guessed it already, today we're talking about the Canadian e-commerce giant, Shopify. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Founded by Canadians Toby Lutke and Scott Lake in 2006, Shopify was originally called Snow Devil and was made to sell snowboarding equipment. However, seeing the possibilities of their platform, the two relaunched it as Shopify 2 months after Snow Devil's initial release date, and in the beginning, growth was quite slow. It really only pulled in about $8,000 a month, but the growth was steady until 2008 when Shopify saw its first large venture capital investment. By the time 2010 rolled around, Shopify was on a roll itself. It was receiving millions in venture capital funding, and the company was growing at a breakneck pace. Soon, the company launched its own payment system, a mobile app, and eventually IPO'd. Then, Shopify received another massive boost from a partnership with Amazon, launching it as the premier go-to platform for any individual person looking to sell their wares online as a small business. With Shopify's main goal to create an easy-to-use platform for anyone at relatively low monthly fees, the company drew in customers by the thousands. In 2020, a year mired by lockdowns, the company really shined because it allowed the newly unemployed and the aspiring entrepreneurs to sell stuff online. And some of these small businesses have really flourished, becoming so successful that they went public. Allbirds, Figs, and Oatly Group are companies that got their start on Shopify. Pretty crazy to think that Shopify has become such a successful incubator of small businesses. But before we get too caught up on the hype of this incredible company, let's take a look at where Shopify stands financially. Of course, let's begin with revenue. In 2015, Shopify brought in $205.2 million that grew to an impressive $2.9 billion by 2020. While the company has seen relatively steady growth, it really took off in 2019, but soared in 2020. Great growth, sure, but we always need to be wary of that post-pandemic drop. Second to look at is shares outstanding, and unfortunately, Shopify has diluted its shareholders, increasing shares from 61.7 million in 2015 to 119.5 million shares outstanding in 2020. Third, I want to look at free cash flow growth. Much like revenue, it has grown exponentially. Shopify lost $5.3 million in 2015, but turned a profit of $383 million in 2020. Good to see, but again, post-pandemic slowdown is a very real concern moving forward. Now let's compare Shopify's 3-year average EBITDA to its net debt. Believe it or not, it actually has negative net debt. Its total assets equal $8.33 billion against its total debt of $2.17 billion, nearly 4 times its debt. If it wanted to, the company could pay off all of its outstanding debts with its current cash on the balance sheet. Now let's see if we can get a rough idea of Shopify's value by examining its free cash flow. If we take the 5-year average of its free cash flow at $66.1 million and multiply it by the market average of 20, we get an expected market cap of $1.32 billion. Currently, the company's market cap is $185.3 billion, so way overvalued, but seemingly common for today's tech companies. Moving on, we're going to look at Shopify's return on invested capital, and it's surprising to find that the 5-year average is only 1%, and this is worryingly low. This may be because the company has consistently lost money over the past few years, but last year's return on invested capital was only 4.8%, way under our 10% goal. Finally, Shopify does not pay a dividend, although I definitely expected this given the company's inability to turn a profit over the last few years. Despite this, I think Shopify is a really strong company with great balance sheet strength. Having more assets and liabilities is great, although the return on invested capital leaves a lot to be desired. With that said, it's time to look at what could drive this company's growth moving forward. I want to start with a very simple graph. In this slide, we see the amount of retail e-commerce in the US. Shopify Shopify-powered stores make up 8.6% of the total market. Only one company stands above it with an impressive 39%, Amazon. This 8.6% of the market saw Shopify do just under $120 billion in GMV. GMV is the total dollar amount that flows through all Shopify-powered stores. This number steadily grew for years until that big spike in 2020. However, even though that was a monster year for the company, 2021 is beating last year's GMV by 35% in the first 3 quarters. How are they doing this? By implementing a strategy some call arming the rebels. The rebels in this phrase refer to the smaller sellers of the great big internet. Shopify is arming them with the platform to scale up and expand their business in a variety of ways. Of course, this is to combat the large e-commerce giants like Amazon, eBay, and Walmart. And really, the strategy has proven extremely successful and very, very lucrative. Speaking of lucrative, before we move on, I want to break down Shopify's sources of revenue. To do this, we'll look at this 2020 year-end report, since it'll give us a pretty clear idea. Now, there are 2 main parts to Shopify's revenue: merchant solution revenues and subscription revenues. The prior brings in more revenue, making up about 69% of Shopify's total revenue, while the latter has a much higher margin. Merchant solutions mostly refers to the fees Shopify collects from Shopify Pay, its payment processing service. It's similar to PayPal's charging 2% of the total transaction to process payments. On the other hand, the subscription revenue is the amount of money the company collects from its monthly subscribers. And that's basically how Shopify makes money. It provides a platform that allows the everyday person an easy and safe way to sell online. Yes, some of the massive partnerships with Amazon and Walmart are missing here, but I think those take second place to the real bread and butter of the company, the individuals, not corporations, who use the platform to run a functional business. But with all these good things come some bad ones too, and there are really only 2 things that I could find. The first of which are competitors. The first, WooCommerce, is built on top of WordPress and is used predominantly by the users of WordPress. Quite cheap and both simple and easy to use, Wix comes in second. And third, BigCommerce wants to compete with Shopify directly. Really, I don't think any one of these will be able to topple Shopify anytime soon, but I imagine there will be plenty of startups vying to dominate specific niches, and this may be a possible threat to Shopify's reign. A slew of new, specialized e-commerce companies could eat away at Shopify's massive lead. Yet the worst problem isn't even really these big competitors or these smaller startups. No, I believe it's the investors themselves. These past few months, Shopify has been on a full-blown run upwards and got itself a share price I think is wholly unsustainable. We can even start to see it somewhat unraveling. In the last 2 weeks, that price has plummeted by 15% on basically no news. Shopify has a price to sales of 44 times, a PE of 54, and a 5-year average PE of 275. All this on a return on invested capital of just 5%. That's just too expensive. I get the argument that dominant companies deserve higher than average multiples, believe me, I know, but how much more? Sure, no other company can relatively compete with Shopify, but how can you justify paying its insane share price considering these factors? On the other hand, I really don't see much downside to the company itself. I think it's nailed its core aspects, the factors that make any company great. Shopify provides a service that anyone can use for a relatively low fee. It can take on big e-commerce players like Amazon and start to win, taking market share while making tons of money doing it. And I have tremendous respect for its founder and CEO, Toby Lutke. Really, I think he has done and will continue to do a great job running the company. So that leaves us with the question, am I buying Shopify? And the answer is no. I love the company, I really do. I think its future is bright and it will continue to dominate the e-commerce space well into the future. I just can't justify paying its current price right now. But if it turns out that we do land ourselves in a market crash anytime soon, Shopify is my #1 top of the list buy. It first just has to fall under about $400. As always, there's links in the description to help you get started on research for Shopify to decide if it's right for your portfolio. And that's all I've got for you. I hope you enjoyed this video on Shopify. Leave your thoughts in the comments section below or join my Discord where we can talk more. Until next time, I'll see all of you in the next episode of Dollars and Cents.